Bill here. Today's Wednesday, September 13th, 2023. Well, we just had the inflation numbers come out and they're coming in hotter than what they expected. And inflation is definitely on the upswing again. And so that's beginning to make an impact in the metals prices. We're seeing this is the end of the sale week. I say the end because I believe the trend is likely to turn back upwards probably later this week. The slowing has slowed to a crawl, and that's usually a sign things are getting ready to turn back northward. Nevertheless, it's been a negative week, just a fraction for gold, down maybe 1% or so for silver and platinum. But palladium has bucked the trend. It's up 3% for the week. And for the 1 year, from a year ago today, we have gold up 13%, silver up 19%, I think platinum's up 3%, and palladium's down over 30%. All the details are in the write-up. Today we want to continue on in our discussion about which one is better to invest in, gold or silver. And as a review, last week we learned that gold is more of a consistent performer over time, and silver is more volatile. And so gold serves a different role than silver typically in a portfolio. It serves to preserve the purchasing power going forward, and it does a pretty good job of that. Silver is more speculative, and it's also a lot more connected to industrial usage. So there's a little more moving parts to silver, makes it a little bit harder to project going forward. But today we also want to talk about a useful tool. It's called the gold-silver ratio, and it's often used as a tool that investors use to help determine whether they should allocate more capital to gold or more capital to silver. And the way it works is you divide the spot price of gold by the spot price of silver, and that gives you the gold-silver ratio. So using today's numbers of the current gold and silver prices, that puts the gold-silver ratio at just over 83. Now, what does that mean? Well, if we look back 30 years, the average, or the central place where the gold-silver ratio would be, is right around 60. So that means that on average, the last 30 years, it would take 60 ounces of silver to purchase 1 ounce of gold. Right now, that ratio is over 83. So that means it takes 83 ounces of silver to equal 1 ounce of gold. That's a little higher than average. So typically what that means is that silver is expected to be a better relative value than gold, meaning that silver may be due for an outsized increase as compared to gold because the ratio is higher than the average. Now, the caveat is that does not mean that the gold-silver ratio cannot go higher still, and sometimes it does. There's been times it's been over 93. There's been times it's been over 100. And typically it doesn't stay there that long, and that's been a really good bargain for silver when it gets up that high. Conversely, when the gold-silver ratio is down below 40, that's typically a sign that gold is a better relative value than silver. And so that's a useful tool, or it can be, when you're deciding whether to purchase more gold or silver at the moment. Right now, the gold-silver ratio indicates that silver might be a better relative value, but as I mentioned last week, I believe in both of them, and they fulfill a slightly different role in your portfolio. So it pays to have both. But for example, if you're preparing to allocate $10,000 today to gold and silver, by looking at the ratio, you might want to allocate 60% to silver and 40% to gold. or somewhere in that range, because silver's a better relative bargain right at the moment. So that's one of the useful tools you can use as you're building your portfolio. Hey, keep on stacking, and thank you for tuning in. Have a great rest of your week.